The United States government owes $38 trillion. That's more money than exists in the economies of China, Japan, Germany, and India combined. It's a debt so massive that if you stacked $100 bills to represent it, the pile would reach from Earth to the moon and back again 17 times. And here's what nobody is telling you. They're not planning to pay it back. Not through tax increases, not through spending cuts, not through economic growth. They're using a strategy so sophisticated, so hidden in plain sight that most Americans don't even realize they're being systematically robbed to eliminate this debt. And the mechanism they're using has worked before. Right now, as you watch this video, the largest wealth transfer in human history is taking place. Not from the rich to the poor, not from corporations to workers, from savers to debtors, from people who plan for the future to a government that spent beyond its means for decades. And they're doing it through a process that sounds boring, technical, completely harmless. Financial repression. Two words that hide the most elegant theft ever devised. This isn't conspiracy theory. This is documented policy. The Federal Reserve has openly discussed these strategies in academic papers. The Congressional Budget Office has modeled the outcomes. International economists have studied the historical precedents. The blueprint exists. The mechanisms are in place. And the execution is happening right now in real time. While everyone argues about politics and ignores the mathematics of what's actually occurring. In this video, I'm going to show you exactly how this works. Not theory, not speculation, the actual mechanics of how $38 trillion in debt disappears without being paid. I'll show you the historical examples where the strategy eliminated over 60% of government debt in just 25 years. I'll show you the specific policies being implemented today that mirror those exact same strategies. And I'll show you who wins, who loses, and why most people won't understand what happened until it's already over. Because this isn't the first time America has faced impossible debt levels. In 1945, after World War II, the United States owed over 120% of GDP. Today, we owe 132%. The debt was mathematically unpayable then, just like it is now. But by 1970, that debt had virtually disappeared. Not through some economic miracle, not through balanced budgets. They called it the post-war economic boom. What it really was the most successful debt liquidation in modern history. Same playbook. Well, welcome to Finance Historian. Here we break down global finance. Just a quick reminder before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city and the time you're watching this. I want to see how global this community is. Let me start with what financial repression actually means because the name is designed to sound technical and boring. It's the systematic use of government policy to force private capital to finance government debt at below market rates. Think of it as a tax that doesn't show up on any tax bill. A transfer of wealth that happens invisibly automatically without anyone voting for it, or even understanding it's happening. Here's how it works in practice. The government needs to borrow money. But if they had to pay market interest rates, the cost would bankrupt the system. Interest payments alone would consume the entire federal budget. So instead of paying market rates, they create policies that force investors to lend at artificially low rates. They cap interest rates through regulation. They create inflation that makes those bonds worth less in real terms while keeping nominal interest rates below the inflation rate. The result is negative real interest rates. That means the interest rate you earn on government bonds is lower than the rate of inflation. Your money loses purchasing power every year you hold those bonds. But here's the key. Through pension funds, through insurance company requirements. The system is designed so that private capital has no choice but to finance government debt at rates that guarantee losses. This is not theoretical. The Federal Reserve with Sony's balance sheet has grown from $800 billion in 2007 to nearly $9 trillion today. They've created over $8 trillion out of thin air to buy government bonds and mortgage securities. That's not quantitative easing. That's debt monetization. The central bank is directly financing government spending by creating money and using that money to buy government debt. But the genius of the system is that it doesn't look like debt monetization. It looks like monetary policy. The Federal Reserve doesn't say they're printing money to pay government bills. They say they're providing liquidity to support economic recovery. They say they're ensuring market functioning. They say they're maintaining price stability. But the effect is identical. The government issues debt. The Federal Reserve buys it with newly created money and the debt gets absorbed into the central bank's balance sheet, where it effectively disappears from the government as immediate financing concerns. Meanwhile, inflation does the real work, not the dramatic hyperinflation that grabs headlines, just enough to steadily erode the real value of the debt without triggering panic. If you owe $38 trillion and inflation runs at 4% for 10 years, the real value of that debt falls to $25 trillion without paying back a single dollar in principal. The debt doesn't disappear nominally. It disappears in purchasing power terms. And here's where it gets really sophisticated. They don't just rely on inflation to do the work. They coordinate multiple mechanisms simultaneously. Interest rate suppression through Federal Reserve policy, regulatory requirements that force banks to hold government bonds, inflation targeting that keeps real rates negative, and economic growth policies designed to make the debt to GDP ratio improve through the denominator effect. Let me show you how this played out historically. In 1945, the United States emerged from World War II with debt equal to 106% of GDP, the highest in American history at that time. Everyone understood the debt was unpayable through conventional means. Tax rates were already at confiscatory levels. Spending couldn't be cut enough to matter because most of the budget was defense spending that had already ended with the war. So, they implemented financial repression. The Federal Reserve agreed to cap interest rates on government bonds at 2 and 8.5%. Regulation Q limited what banks could pay on deposits. The government required financial institutions to hold specified percentages of their assets in government securities, and they allowed inflation to run higher than interest rates for decades. The result was extraordinary. By 1970, debt to GDP had fallen from 106% to 37%, a decline of 69 percentage points in 25 years. But here's the critical detail. Of that 69-point decline, only about 20 points came from running budget surpluses. The other 49 points came from financial repression. Negative real interest rates controlled inflation and forced investment in government bonds transferred the real burden of the debt from the government to private savers. This wasn't accidental. It was coordinated policy between the Treasury and Federal Reserve. Carmen Reinhart and Ben Sprankea documented this extensively in their research on debt liquidation. They calculated that financial repression generated an annual debt reduction equivalent to 3 to 4% of GDP throughout the Bretton Woods period. That's a hidden tax of 3 to 4% of the entire economy every year for 25 years. And the beautiful thing about this tax from the government's perspective is that it's invisible. Unlike income taxes or spending cuts, financial repression doesn't require legislative approval. It doesn't show up in budget documents. It doesn't generate protests or political opposition. People feel poorer over time, but they can't trace it directly to government policy. They blame inflation on supply chains, labor shortages, corporate greed, anything except the systematic monetary expansion that's actually causing it. This is happening again right now. Same coordination between Treasury and Federal Reserve. Same regulatory requirements forcing private capital into government bonds. Same inflation running above interest rates on government securities. Same gradual currency devaluation that makes dollar-denominated debt easier to service. The only difference is scale and sophistication. The mechanics are more complex today because financial markets are more sophisticated, but the underlying strategy is identical. Transfer the real burden of government debt to private savers through policies that guarantee negative real returns on government bonds, while making it impossible to avoid holding those bonds. Consider the current implementation. The Federal Reserve holds nearly 30% of all outstanding Treasury securities. That's not a free market determining interest rates. That is the central bank artificially suppressing borrowing costs for the government, while forcing everyone else to compete for the remaining 70% of bonds at whatever rates the Fed allows. But the real innovation this time is regulatory capture of the entire financial system. Basel banking regulations require banks to hold specific percentages of their capital in government securities. These aren't recommendations, they're legal requirements. Banks must buy government bonds or face regulatory penalties that could shut them down. Insurance companies face similar requirements. Pension funds are guided toward government securities through tax incentives and fiduciary rules. Money market funds are required to hold government debt to maintain their regulatory status. The result is a captive market. Private institutions are legally obligated to buy government bonds regardless of whether those bonds provide adequate returns. The government doesn't need to offer competitive interest rates because the buyers don't have a choice. They buy or they face regulatory consequences that threaten their existence. Meanwhile, the inflation targeting framework provides perfect cover for the strategy. The Federal Reserve maintains their targeting 2% inflation for economic stability. But 2% inflation with 1% interest rates means negative 1% real returns for bondholders. Your purchasing power declines every year you hold government securities. But it's presented as sound monetary policy rather than systematic wealth confiscation. And here's where the mathematics become undeniable. Every percentage point of inflation above the interest rate on government bonds transfers approximately $400 billion annually from bondholders to the government. With $38 trillion in debt, 4% inflation and 2% interest rates means the government captures approximately $760 billion in real value from creditors every single year. That's debt reduction without payment. That's wealth transfer without legislation. That's taxation without representation in its most sophisticated form. The currency devaluation component amplifies this effect exponentially. Unlike most countries that hold debt in foreign currencies, the United States holds virtually all its debt in dollars. This creates a unique advantage. When the dollar weakens against other currencies, it doesn't increase the debt burden because the debt isn't denominated in foreign currencies. Instead, it makes the debt easier to service because the government pays back with depreciated dollars. The dollar index has fallen over 11% since January. That's the largest decline since 1973. This is an accidental market movement. This is coordinated policy to reduce the real burden of dollar-denominated obligations. Every percentage point the dollar declines makes the debt approximately $300 billion easier to service in real terms. But currency devaluation serves another critical function. It forces international holders of U.S. debt to absorb losses in their domestic currency terms. Foreign central banks hold approximately $7 trillion in U.S. Treasury securities. When the dollar declines, those bonds lose value in euro terms, yen terms, UN terms. Foreign governments are subsidizing U.S. debt reduction through currency losses they can't control. This is economic warfare disguised as monetary policy. The United States exports inflation to trading partners while reducing its own debt burden through currency manipulation. Other countries face the impossible choice of allowing their currencies to strengthen, which destroys their export competitiveness, or weakening their currencies to match the dollar, which imports inflation and reduces living standards for their citizens. The economic growth component provides the final layer of debt reduction through mathematical manipulation rather than real payment. When GDP grows faster than the debt to GDP ratio improves automatically. Not because debt decreased, but because the denominator in the equation increased. The government doesn't need to pay down $38 trillion in debt if they can grow GDP to $50 trillion. Suddenly, the debt represents a smaller percentage of the economy, even though the absolute amount hasn't changed. This is why modern economic policy focuses obsessively on nominal GDP growth rather than real economic improvement. Inflation contributes to nominal GDP growth just as much as actual productivity increases. If real economic growth is 2% and inflation is 4%, nominal GDP grows at 6%. The debt to GDP ratio improves even though real economic output barely increased, and living standards decline due to inflation. The Congressional Budget Office models show that sustained 3.2% annual GDP growth would reduce debt to GDP to 23% by 2055. But that's nominal growth, not real growth. Much of that improvement comes from inflation, inflating the GDP denominator rather than genuine economic expansion. The debt burden appears to decline while the real purchasing power of American workers erodes steadily. And here's where the strategy becomes truly diabolical. The people absorbing these losses don't understand what's happening to them. Retirees watch their savings lose purchasing power every year, but blame it on corporate greed or supply chain disruptions. Workers see their wages by less each month, but attribute it to housing costs or energy prices. Savers are negative real returns on bonds and bank deposits, but accept it as the new normal in a low-interest rate environment. The wealth transfer is invisible because it's distributed across millions of individual transactions rather than concentrated in obvious confiscation. Nobody receives a bill for their contribution to government debt reduction. They just gradually become poorer while the government gradually becomes more solvent. The burden shifts from the public sector balance sheet to private sector purchasing power through mechanisms too complex for most people to trace. This is financial engineering at its most sophisticated. The government eliminates debt without defaulting, without raising taxes, without cutting spending, and without political accountability. They accomplish through monetary policy what would be impossible through fiscal policy. They achieve through technical complexity what would generate revolution if done transparently. The international precedents prove this strategy works exactly as designed. After World War II, advanced economies reduced debt to GDP ratios from over 100% to approximately 20% in 25 years. The mechanism was identical: financial repression, controlled inflation, regulatory capture of domestic savings, and coordinated monetary policy that transferred real wealth from private savers to government debt reduction. But the current implementation exceeds anything attempted historically in terms of scale and coordination. The Federal Reserve's balance sheet operations dwarf anything seen in previous debt liquidation episodes. Global central bank coordination through institutions like the Bank for International Settlements ensures that currency manipulation occurs simultaneously across multiple economies. Regulatory frameworks force private capital into government securities with unprecedented precision. The system is designed to be self-reinforcing. As inflation erodes the real value of existing debt, it creates space for additional borrowing without increasing the debt to GDP ratio. As regulatory requirements force more private capital into government bonds, it expands the captive market for new debt issuance. As currency devaluation makes exports more competitive, it supports nominal GDP growth that improves debt ratios through the denominator effect. What you're witnessing is the controlled demolition of the dollar's purchasing power to eliminate government debt obligations. It's the systematic transfer of wealth from everyone who holds dollars to the institution that issues dollars. And it is happening with mathematical precision designed to avoid triggering the kind of crisis that would expose the strategy to public scrutiny. The timeline for completion runs through the next decade. Based on historical precedents and current policy trajectories, debt to GDP should decline from 132% to approximately 40% by 2035, not through debt payment, but through debt liquidation via controlled inflation, financial repression, and currency manipulation. The $38 trillion debt will still exist nominally, but its real burden will have been transferred to everyone who held dollars during the transition. The beauty of this strategy lies in its political invisibility. Unlike tax increases that generate immediate voter backlash or spending cuts that create organized opposition, financial repression operates below the threshold of public awareness. When your grocery bill increases by 20% over 2 years, you don't blame monetary policy. You blame greedy corporations or supply chain issues. When your savings account earns 0.5% while inflation runs at 4%, you don't connect it to government debt reduction. You accept it as market conditions. This psychological barrier is crucial to the strategy's success. The complexity creates plausible deniability. Federal Reserve officials can testify before Congress about price stability and full employment without ever mentioning debt liquidation. Treasury officials can discuss fiscal responsibility while implementing policies that systematically reduce debt burdens through inflation. The technical language obscures the wealth transfer happening in plain sight. Consider how this plays out for different segments of the population. Retirees who plan conservatively and hold government bonds watch their purchasing power evaporate at 3 to 4% annually. They receive their promised interest payments, but those payments buy progressively less each year. A bond paying 2% nominal returns loses 2% annually in real terms when inflation runs at 4%. Over a decade, that's a 20% reduction in real wealth. Young workers with variable rate debt benefit enormously from the system. Their wages adjust upward with inflation while their debt payments remain fixed in nominal terms. A mortgage payment that consumes 30% of income today might only consume 20% of income in 5 years if wages rise with inflation while the mortgage payment stays constant. The debt doesn't disappear, but it becomes dramatically easier to service with inflated dollars. The government occupies the ultimate debtor position in this arrangement. Every dollar of inflation reduces the real burden of $38 trillion in debt by approximately $380 billion. When inflation runs 2 percentage points above the average interest rate on government securities, the real debt burden declines by approximately $760 billion annually, without any principal payments. That's more debt reduction in 1 year than most countries achieve through decades of austerity. But the strategy requires perfect execution to avoid triggering a confidence crisis that could spiral into hyperinflation. The inflation rate must remain high enough to erode debt burdens, but low enough to maintain public acceptance. Currency devaluation must occur gradually enough to avoid international backlash, but consistently enough to provide real debt relief. Interest rate suppression must continue long enough to transfer substantial wealth, but not so long that it destroys the financial system's credibility. The Federal Reserve faces an impossible balancing act. Push inflation too high and risk losing control of price expectations. Keep inflation too low and fail to achieve meaningful debt reduction. allow interest rates to rise, and watch government interest payments explode beyond manageable levels. Keep rates too low for too long and risk asset bubbles that threaten financial stability. This is why the policy operates through coordinated signaling rather than explicit announcements. Federal Reserve officials discuss data-dependent policy while consistently choosing the most accommodative interpretation of economic data. They target 2% inflation but consistently overshoot while explaining away the excesses transitory factors. They promise to normalize monetary policy while finding reasons to delay normalization indefinitely. The international dimension adds another layer of complexity. Other major economies face similar debt challenges and employ similar strategies. The European Central Bank maintains negative interest rates while purchasing government bonds across Eurozone countries. The Bank of Japan has pursued yield curve control that caps government borrowing costs regardless of market conditions. The coordination isn't formal, but the incentives align perfectly. When major central banks simultaneously pursue financial repression, it reduces the risk of currency crises that could derail the strategy. If only the Federal Reserve suppressed interest rates and allowed inflation to run above target, the dollar would collapse relative to other currencies. But when all major central banks pursue similar policies simultaneously, exchange rates remain relatively stable while debt burdens decline globally. So there you have it. The silent trick that makes $38 trillion disappear without payment, without default, without political accountability. Financial repression disguised as sound monetary policy. Inflation targeting that systematically transfers wealth from savers to debtors. Currency manipulation that exports the costs to foreign creditors. And economic growth accounting that makes mathematical decline look like improvement. The most sophisticated theft in human history executed with precision that would make previous generations of central bankers weep with envy. Your purchasing power is the collateral damage in a debt liquidation strategy that spans decades. The only question is whether you all recognize what's happening before it's too late to protect.